What is up, YouTube? I'm Adam O'Dell, Chief Investment Strategist of moneyandmarkets.com. I'm joined by my research analyst, Matt Clark, and we're here for another week of Ask Adam Anything. Last week or the week before, I put out a feeler. I said, if you have specific stocks, specific ticker symbols that you want us to analyze through either our green zone rating system, which looks at 6 factors, or any other type of analysis that we do, send us the ticker, send us the companies. We'll figure out the best way to analyze them and give you some feedback on that. And lo and behold, you guys came through. We have, I believe, Matt, you said you have 2 ticker symbols, 2 companies we want to look at. They sound quite different. I've done a little bit of research ahead of time, obviously. So they're quite different types of stocks. So we'll dig into those today. So thanks for sending those tickers. And if you have more, keep them coming.
Yeah, absolutely. And again, thank you for everyone who does email. We've received a great number of feedback, both on our email, which is feedback@moneyandmarkets.com. We'll drop that address below throughout the video, which is where you can send any of the questions you might have that you'd like me to ask Adam. Also on YouTube, you're watching this as a video. If you want to comment down below in the comment section of YouTube and ask a question, certainly able to do that as well. Any place you like to do that. But yeah, I have 2, and I did want to give these out to you a little bit ahead of time, because I want to make sure you had some time to look them over and it wasn't just a shock to you. But I'll start off with my email. Greg emailed and he says, I know this isn't an exciting stock or high flyer, but maybe you could consider reviewing it for more of your boorish viewers like me. It's WMPN. That's WMPN, William Penn Bancorp. I'm onto this due to the recent amount of insider buying per openinsider.com. It appears they did a 3-for-1 split recently. They pay a small dividend, and the PE is very high, in my opinion. Are they in this for a takeout at some point? Thanks for considering, Greg. Greg, thanks for the question, Adam. William Penn Bancorp.
Sure. So first of all, there's nothing wrong with looking at stocks that aren't necessarily high flyers. In fact, that's where a lot of the alpha is, whether it's a low beta, low volatility stock, or just a stock that's not on the radar of Wall Street or on the headlines. Maybe it's a small stock. There's a small cap premium where you earn better returns over time in small caps. So certainly you're on the right track there. There's nothing wrong with looking at a small stock like William Penn Bancorp. Just to set the kind of the parameters here, this has a market cap of $180 million. So this is not only considered what would be considered a small cap stock, it's even smaller than that. It's probably considered a micro cap stock by most people's definition. So this is a very, very small stock. If you pull up a stock chart of WMPN, you'll see that it is also sparsely traded. So there's a lot of gaps. It's very thinly traded, very little volume. So if you are buying shares, you want to be very careful with that. Use a limit order, leg into your order if it's a larger one. But that certainly shows that this is not a hot stock, so to speak. As far as I can't really speculate as to whether it's a takeout target. Certainly with the size, it could be. I don't know if there's any talks of that, but it'd be pure 50-50 speculation if I was to weigh in on that. But you're right, the price to earnings, the valuations are not good. I do want to make a note on our 6-factor green zone model. It typically tries to rate all stocks, but mostly stocks that have a market cap of over 250. So that's what you see if you go to moneyandmarkets.com and you type in a ticker symbol. You actually will not get a reading for William Penn Bancorp. So I actually had to do some analysis behind the scenes to include stocks that were sub 250 million. And you know how that works, Matt, because you obviously run a lot of my analysis. So it did get a very poor rating. It was like a 26 out of 100 or so. But a lot of the metrics weren't even rateable. A lot of the data is rather sparse. But on the valuations, I cannot make a strong case that this is a cheap stock or this is a good value stock. So you are on the right track there as far as it not being the best play. That said, as far as insider buying as well, I did some research and found over the last 6 months, there was about 420,000 shares of the stock bought by insiders, but that's really only about 2.5% of the total shares outstanding. So it's not a large portion. I'm actually familiar with a financial services company that we're recommending soon in our newsletter that has 78% of its shares owned by company insiders. So if you want to talk about putting your money where your mouth is and having faith in your own company, then that's the sort of insider buying activity that you want to look for. So to me, 2.5% of insider ownership is not all that exciting. So I do want to just give a word of caution with stocks like this that are either very, very small, have holes in their data, don't have a complete data set, or are very new. WMPN isn't necessarily new, but those aren't necessarily the best candidates for ranking on our 6-factor green zone model, because you really have to do your own due diligence and kind of do some discretionary analysis. And you can't necessarily look at that quantitative model, which looks at 75 metrics over look back periods of anywhere from 6 months to up to 10 years. So that's certainly why newer companies don't rate as well, and you have to kind of look beyond the numbers. I will say that in Green Zone Fortunes, our flagship newsletter, where we offer one actionable buy recommendation per month, we are bullish on regional banks. So we are on the right track with William Penn. In fact, a few months ago, we added a regional bank. It's very small, so it has a size rating of 99 out of 100, which means it's a small company. It's a $955 million market cap. But this regional bank rates overall on our Green Zone stock factor ranking model of 98 out of 100. So it gets an 81 on momentum, 84 on value, 74 on quality, 83 on growth. So just to kind of compare, this stock trades with a P/E ratio of 12.8, which is extremely cheap. It's either, depending on what market index you look at, it's either half or 1/3 of the valuation of most stocks these days. It trades at a price to book of 1.7. So that's very cheap. It also has a net profit margin of 34%. So that's highly profitable. That's why it gets a very good quality score. This question mentioned that William Penn pays a decent dividend. I think it's about 1 or 1.1%, which isn't awful these days. I mean, it's paying something, but I will say that the regional bank that we recommended in Green Zone Fortunes pays an annual yield of 2.4%. So more than double that, and even more than what you'll get as far as yield on a 30-year treasury bond. So if you want to go with the regional bank, I would not necessarily go with William Penn. I'd go with something a little bit more established and well-rated. And you can certainly get access to that stock for not all that much if you sign up for Green Zone Fortunes, our monthly flagship newsletter. So that's my opinion on William Penn. And I'm excited to look at the next stock as well.
And to kind of capitalize on that, not to steal any thunder or to go back, but I remember in a previous video that you and I did, one thing you said kind of stuck out, and it's one thing that I think investors, whether you're novice or whether you're experienced, need to remember, and that is, sometimes it's best to look where others aren't looking for potential gains. And so I think you're right. Greg is definitely on the right track here in terms of kind of looking away, not looking at a high flyer, not looking at a big mover or a headline grabber, but looking at one that is kind of off the radar. And I think that's very smart for not just Greg, but for investors in general to do. So I just want to drop that in there because I just remembered you saying that. And I thought that was very sage advice for investors. But yes, again, if you are interested in learning more about the stock that Adam recommended a few months ago, then I certainly encourage you to check out Green Zone Fortunes. We'll put a card or link up here in the video so that you can click on it and get more information on how you can find out more about that. Now, the last one here, this one comes from YouTube. And it says, I would love to know what you guys think about Enphase Energy long-term. That's Enphase Energy long-term. And he did say, thanks for the vids. Thanks for the vids, guys. He had a comment towards the end of there. I'm going to leave that off because it was a little vulgar and I didn't want to do that. So Enphase Energy is the stock that this viewer was wanting to get a little bit breakdown on.
Sure. So Enphase Energy. So, to use your kind of your transition there, there isn't much alpha in crowded trades. So that's what you're saying. Looking for overlooked opportunities, under the radar opportunities is where a lot of the alpha is. And that's how I would characterize Enphase Energy, not as a overlooked, but as a very looked at, a very popular crowded trade. So Enphase trades at about $170 per share at the very bottom of the March 2020 crash. I traded for just about $20, maybe $1 or $2 above it. So we're basically talking about a 750% gain over the last 15 months or so. So the stock has certainly run up. This is the problem I have with Enphase. It's its valuations. Okay. So if you head to moneymarkets.com, go to the top right-hand corner, you'll see in Green Zone Ratings, this little dialog box, type in ENPH and click go. And you'll see the 6-factor Green Zone rating for Enphase. You'll see it rates overall 38 out of 100, which is a bit below average. Not typically the stock we're looking for in Green Zone. We're typically looking for 80 or above unless there's a special situation. Where does Enphase rate poorly on? It rates poorly on momentum because it's actually had a recent pullback. It rates poorly on volatility because its average range and its beta is very high. But it also rates poorly on size, a 9 out of 100. And that's because it has a rather large market cap of $23 billion. But its worst rating is on value. It gets a value rating out of 4 out of 100, which means that out of all the stocks we rate, 96% of them you can buy with a better valuation than you can buy Enphase. And that's really the concern I have with buying Enphase at this price. Price you pay does matter, specifically over the long run, which is what this user asked about, the long run implications of Enphase. I think the company, what they're doing is great. Enphase is basically allowing, basically commercial companies and residential customers alike to, bank solar power and use that and to get off the grid or to have it as a hybrid model. And there's nothing wrong with that. I think that the company's technology and their service model and everything is solid. It's just the fact that there is a difference between a good company and a good stock. And the stock at this price, to me, is not a good stock. Just to give you some of the metrics, their price to earnings ratio is 275 price to earnings ratio. And it's like moon. Nosebleed. Their price to cash flow multiple is 213. Their price to book is 34. Their price to sales is 28. So all of these metrics are many, many multiples higher than the industry average. So you have to realize that, yes, the company is profitable. They have a net margin of 11%, which isn't all that bad. But at the same time, the price you're paying today is really going to hamper the returns you can earn over the next 1, 3, 5, or 10 years. So, this is one of those stocks that if you like the company, wait for a much, much sharper pullback, wait for a much, much stronger increase in earnings. So you really want to see that PE ratio come down to much, much more reasonable levels. We are in Green Zone Fortunes very, very bullish on the clean energy space. Okay. So that's why I have a hard time saying don't go out and buy Enphase, but it's just not a good stock, in my opinion, based on valuation. But if you are interested in clean energy, we have a number of plays already in the portfolio that are targeted toward the clean energy, renewables energy, infrastructure space. And we have about 3 to 4 recommendations coming down the pike in the next, probably, I'll say 6 to 8 weeks, that we will be rolling out to the newsletter. So if you're interested in good research on clean energy plays, certainly sign up for Green Zone Fortunes. Very nominal annual cost, and you get a lot of research from myself, co-editor Charles Sizemore, and behind the scenes and in front of the video, Matt Clark does a ton of great work for us. So just to give you an idea, in our monthly newsletter, we just recommended an infrastructure play. We believe that the power grid is going to be revamped in a very demonstrable, very lucrative way to bring in all of these renewable sources, solar and wind. And we found an established company with a $12.6 billion market cap. It is like the industry leader in doing all of the work on these utility type of operations. They rate 87 out of 100 on our Green Zone factor model. So they basically are a very well-rounded stock, whether you look at the stock's momentum or in volatility, or whether you look at the company's fundamentals like value, quality, and growth. This stock trades with a PE ratio of just 26. So, not quite, maybe like 1/9 the valuation of Enphase. And it trades with a price to book of just under 3 times, 2.9. So again, a much, much better valuation. So that's really what you want to look for. We also have a solar energy stock that's in the portfolio. It's been in there a bit longer. It's been in there almost a year, but we've already seen a double in the price of this solar stock. Just to give you an idea why valuation matters, I'm a momentum investor, but we built the 6-factor model because we know that price does matter. When I recommended the solar company about a year ago, I labeled it the cheapest solar stock you could possibly buy. And that was a year ago. Right now, this solar stock trades with a PE of 39, which is very, very reasonable when you look at the overall industry. It trades with a price to book of 1.67, which is super cheap, and price to sales of 0.7. So this is a very cheap stock. And realize this is as of today. I recommended this a year ago when these metrics were even cheaper. So the stock has already doubled. We've taken over 100% profits on half of our position in this stock because it was so cheaply priced that just a little bit of multiple expansion really gave us a ton of value in that stock. So that's another thing to look at. That's currently it's currently buy rated. So you can still buy in at today's prices if you sign up for Green Zone Fortunes today. And then lastly, 2 other stocks we're going to be adding in the next several weeks. One is a new stock that can't really be rated on the rating system because it's too new. It came public via a SPAC. But we've done a lot of due diligence on that company. We think it's going to be the leader in large scale battery storage. So these utility companies and these large corporations that want to store their energy to kind of go back and forth with the grid and not be solely dependent on the grid. This is going to be the leader. They already have 75% market share in California, which is the biggest market in the US. So we're super hyped about that company. And then finally, there are backdoor ways to get into the clean energy space. So for example, there's a German car maker, I won't name them by name, because we haven't recommended them just yet, but this German car maker rates 90 out of 100. So it's very well-rounded. It's very cheaply priced with a 97 out of 100 rating. But basically, they are the largest investor in a brand new battery company, a solid state battery company that's very innovative. And basically, that's going to allow them first dibs to this technology. And this company has very aggressive plans to have basically their whole fleet electric or hybrid within the next several years. So this company's investment in this new battery company, the battery company itself right now isn't that attractively priced, but this car company got in at a good price. And so they have a lot of good investment there. And I think that they're going to really be able to leverage that to increase their profit margins on their cars and trucks. So that's just another way to look at the clean energy space. You don't have to go for the obvious plays. Enphase is an obvious play. A lot of ink has been spilled on Enphase, but we are looking for kind of under the radar opportunities within that space. And we would certainly encourage you to sign up for Greenstone Fortunes, where you can find all of our research.
Absolutely. And thank you for all the questions that we received. Again, if you do have a question you want me to ask Adam, whether it be a particular stock, maybe there's a sector question that you have or something like that. Maybe you'd like to know more about Adam's wardrobe. You can certainly do that. I know that was, I tossed that out there because I just didn't want to keep going with the picture. You can do that by emailing us at feedback@moneyandmarkets.com, or you can comment below on our YouTube channel. We'll just write down there if you have a question. We look at those all the time. Love your feedback. And then also, if you are interested in finding out more about Greenstone Fortunes, but I certainly encourage that you do, we'll have a card throughout the video where you can kind of click and get more information on how you can become a member of Greenstone Fortunes and get even more actionable advice from Adam, Charles, and myself. Throughout the course of an entire month. We try to give updates as much as we can, let you know what's going on in the market, let you know what's going on with the portfolio, plus additionally giving you recommendations, one recommendation a month that I can tell you without giving away too much, those recommendations have panned out nicely. So far. So I just want to, there's my plug. There's my shameless plug. But again, feedback@moneymarkets.com. Let us know what you'd like us to talk about.
Thanks so much, Matt. And we'll do this again next week. It's good.
Absolutely. Looking forward to it.
All right. Thanks, Matt. Take care.